Matching principle is an accounting principle in accrual accounting that states that any revenue needs to be matched up with associated costs for that revenue in the same time period. So they go together like peanut butter and jelly, like two socks together. I know this sounds really, really boring and really dry, but this is important. And the reason why this is important is because if your P&L looks like this, it's essentially a roller coaster. This might be the reason why. And the reason why is because it could be that you have certain revenue come in, but the costs associated with that revenue might come in a couple of months before, a couple of months later. So you're not doing that matching. And this is a problem because when you're looking at your financial statements, they're not going to be accurate. And this is one of the reasons why when I start looking at the companies that I work with, the first thing that I do is I take a look at, are they really doing the matching principle of the revenue and the cost? Because if they're not, then we're going to have a problem when it comes to financial analysis, figuring out the projections and everything else around the business. So let's go back to the whole sock analogy. Let's say I have a couple of socks right here. Let's say that I have 6 different pairs of socks. These are different colors. I have dark blue one, orange one, yellow one, light blue one. And let's say that obviously these are pairs. So the right pair is revenue and the left pair are expenses for that particular sock. Let's say that I'm selling you a dark blue sock this month in March, but I have all the expenses that come in are actually for my orange sock. So what this means on my profit and loss statement is that I am recognizing my revenue for the dark one, the dark blue one, but all the costs associated with it are for the orange one. And maybe I have more socks, which I do. I have more costs that came in because I ordered more socks. I have, let's say, a yellow one. And then I have a purple one. So what this is telling you right here, you see a problem. I have cost for these particular socks, but the revenue came in for here. So this is an absolute no-no. What you really need to do in this case is recognize cost for this one, right? So this is going to be your revenue and this is going to be your cost. So you have a dark blue sock matching a dark blue sock. This is a properly recognized revenue with the matching principle where you have both of these matching versus having a mishmash of colors that's product or services that don't relate to that particular period.